Hey guys, Freaky Finance here. Last week we looked at duty-free play reopening, and this week we're going to look at a more traditional company, specifically on the Canada side, though with a similar theme. It is a global company. Today I'm talking about Power Corporation of Canada. Many people know, if you're in Canada, that there's pretty much like three insurance players, main players. You got Great-West Life, which is now Canada Life. I'm probably going to call them Great-West Life throughout this video because that's how it's ingrained in my head. But then you also got Manulife and Sun Life, and we'll go through Great-West Life today, but kind of through Power. But Power is like a holding company. It has its, I imagine it kind of like an octopus that has its tentacles in all these different parts of the world. All right, so let's get to it. So Power is kind of complicated. Originally I was going to try to go through all the numbers, but the Q4 2020 report was 524 pages or 34 pages. So I'm kind of going to go through all the holdings that it owns instead of going through every single individual, and I can't really do that inside a 20 to 30 minute video. I'm probably going to go through some of these at a different point individually, but for today we're just going to go through all the different holdcos. I should say that I do own this one as well. This was actually one that I picked up fairly good timing during the COVID panic. You might think, okay, it's up 70%. Why would I think about it now? The thing is, with insurance companies, this company still only has a PE of 10 or 11. And usually how insurance, and it's like 50% insurance company and 50% an asset management company. Usually how they work is always the economy does better and the interest rates start ticking up, financials do better. And this benefits from both the insurance aspect as well as the asset management aspect. So that's kind of the thought process, and how I'm not usually big on holding finance companies, but basically how I do it is during the market cycle, I slowly start selling banks, and then I buy long duration bonds like near the very end of the cycle. So like 2019 I started slowly doing that. And then what happens is when there's this, whatever the event there's going to be, there's always an event every 7 to 10 years or so, right? Basically the long duration bonds perform well because they cut interest rates to accommodate the whatever calamities at hand, or if it's just a recession, whatever. So they just drop interest rates, and then my long duration bonds do well relative to anything else than equities. And then what I do then is that I sell the long duration bonds. I buy companies like Power. And that's what I did for this COVID crisis, is that I had these VLBs. So it's like an ETF for Vanguard long bonds. It's like, like a 15 duration bond. And so it performed well during the panic, and then I sold it, and then I bought Power. And that's kind of how I use financials. It's kind of like my financials and bonds are connected. So right now I have very little bonds. And then what's going to happen is we slowly get out of this. We start accelerating and slow, steady growth over the years. I'm going to slowly sell Power, and then I'm going to buy long duration bonds again in the cycle. That's how I kind of do it. And I thought I'd do that as a backstop for why I like financials. It's not like this company, like duty free, like the DeFry that I did last week. That one has the potential to be something far greater, right, in price. Like that could double or even triple, right? Power at this point probably isn't going to double or triple, though it could because its PE is 10 and it pays a 5.4% dividend, right? So anyway, I'm kind of going on a tangent there, but that's kind of how I think about financial companies. Not like a way to make a lot of money. It's just you get a steady dividend, and right now Power is cheap. So that's why I'm doing the video. Power basically owns 3 key holdings, and then they have a whole bunch of other ones. So Lifeco is the biggest component of Power, and through Lifeco, which is Great-West Life, they have Canada Life, which also owns Irish Life. On the US, they have Power, which now owns Personal Capital. So there's a lot of moving pieces, and we're going to go through that real quick. And then they also have IGM, so that's more of your traditional asset management and assets under administration. So your AUM and your AUA. And then you also have GBL, and I kind of view that as like their exposure to European equities, specifically French equities. And then I also have fintech. So, and this is kind of exciting because a lot of traditional like insurance companies, they're trying to get fintech, but I feel like Power's actually done a very good job by locking up Wealthsimple in Canada, which is kind of like, I want to say it's the Canadian equivalent of Robinhood, I guess. I don't know. But it's kind of like that idea. And they also had like Personal Capital, I think was a good catch as well. And then they have more alternative, and we'll go through these as well in a second. And they also have China directly for asset management. And it's kind of interesting how holding companies work is that So Power owns 13.9% of China AMC directly, but through GBL, they also have another 13.9%. So you can see how their holding co-strategy works. So the net asset value per share kind of tells you which companies are important. So I just listed a whole bunch on that other slide, but you can see here the percent of gross asset value. Those three equal 80%, right? So Great-West Life is a material part, so that's the insurer. And they also have asset management as well. And then you have IGM, strictly more of like an asset manager play. And I've already gone through these. So you can see which ones matter, which ones don't. Like they all technically matter. More importantly, on this slide, you can see that the net asset value is 41.27. And I think Power just closed at like 33. So it's trading at a discount to its NAV. Whenever you see NAV discount, doesn't mean it's going to close. It just means that it's cheaper than the sum of its parts. And usually that kind of suggests that the management of the company, that either investors think that they just add cost, or at least the very least the holding co structure doesn't add value. I guess that's how I word it. So in this case, I think over this 2020 year that we just had, I think management did add value. And I'm surprised the NAV is actually still as high as it is. Like it doesn't need to close, but I mean, right now it's so like I think the gap's over 27% or something discount to NAV, so it's a material discount. And I think they've made some good decisions in 2020 that haven't been really appreciated by the market. So Great-West Life, I had to go through every investor presentation for every individual company to try to get a list of what they do real quick. So Great-West Life, 45% of their earnings are in Canada through Canada Life. 10% is in the US through Empower and Putnam. Empower is pretty good. Putnam, they timed that investment, I think, to like 2008. They got in, so it kind of sucked for Great-West Life then because they literally got in right at the right before the great financial crisis, which crushed financials. And then you have 26% right out of Europe, so UK and Ireland. They have Irish Life as well, and they also have a decent amount, 20% of their base earnings on reinsurance. So what insurance companies do, I know we haven't gone through a financial company yet, but insurance companies, when they make premiums, they can decide to sell them to other insurance companies. It's called reinsurance, and all they do for that is they're trying to manage the risk of their book. So say if they have too much of this one risk, they can sell it to another company, and that company can sell their risk to their company, right? And it kind of just spreads the risk around. That's the idea behind it anyway. You can see fairly diversified. It is still quite a bit of exposure to Canada. We also have a bit in the UK and US and Ireland. And again, with the global theme of investment and trying to get investments that don't have as much home bias to North America, I think this is an interesting play. Great-West Life, I kind of brought up that their Putnam investments as well. 2007, not a great time. But you can see they've made some good decisions lately. I think Empower was good. I think Personal Capital was good. We'll talk about those in a second. So IGM, I'm trying to go a little bit quick, mainly because it's Easter weekend. But you can see here, wealth management for IGA is 65% of EBIT. And then you have asset management, the Mackenzie side. That's 22% of EBIT. I did find it interesting that AUM is 187 million, so assets under management, and then assets under administration for these guys is only 133, but it's higher part of the EBIT. It's kind of interesting. But yeah, and then like I said, IGM also owns like how Power kind of owns things. They might own things directly, but they're also going to own things through the other companies that they own. So it's kind of like Power Co is like a holding company, and sometimes it's a holding company of a holding company, right? It kind of, like I said, I kind of view it like an octopus. So grab a little bit of the company in this company, and then I'll grab another bit of the company in this company, and then before you know it, they have ownership of the entire company. And that's what happened with Wealthsimple down here. And right now they own about more than 25% anyway of China AMC. The asset management business has done well in 2020. I think a lot of people saw the retail traders in Robinhood, right? And they say, oh my God, there's more people active in the market, which I think from my point of view is a good thing, right? Another side effect is that obviously if there's more people in the market, they have more cash than they've ever had before. And you see this now with mutual funds as well. So people aren't just, as the media would say, going on Robinhood and YOLOing all their income, right? There are people that are taking the money and investing it through more traditional ways. And with asset managers, and mutual fund sales are very high, especially in the last quarter of 2020. And I think they're again in Q1 2021, but we'll see when we see those numbers. Today is April 3rd, 2021, so just finished the first quarter for a lot of these guys. And I think the cash inflows for mutual funds will be high again. And usually that happens right after a big panic, so that the capital comes rushing back after. And in this case, there was so much liquidity because the government, especially on the American side, is printing quite a lot. So GBL is another interesting one. I thought it was kind of neat. So this is a holding company that Power owns, which Power itself is a holding company. It's Belgian, but I found like when I started going through, this is their lists of their investments. A lot of these are French, right? And to be fair, French, I mean French, and then they're global, but they start in French. So you have Adidas, 6.8% ownership. I'm not that familiar with all these ones, honestly, but I know Adidas. I think Nike and Adidas Nike's already killing it. I think Adidas is gonna finally catch up. Something to think about. It's just more exposure. If you don't have any European exposure, you have some through GBL. And GBL, well, not huge part of the company. It's still 8.5% of the NAV. It's the third biggest part of the company. So let's jump back to Sagard. So Sagard Holdings is just alternative asset management, and that can mean a lot of things. But again, it's like a place, say, like if you're a retail guy, you're not usually going to be sitting at the table. This is how you could sit at the table. It's through Sagard. And Sagard, for these guys, I'm going to keep going back to this slide just to help. You can see it's only 3.8% of the NAV. So it's small, but they got their hands in quite a few investments, right? And these are things that wouldn't be on public exchanges. They're just things that they can invest in through their investing arm. Energy infrastructure. So this is interesting on the power sustainable side. So right down here, power sustainable capital, about 5.6% of the assets. So one part is just energy infrastructure, so your green energy play. And I think that's good as well, just prudent diversification. And so far, lately they've been able to capture trends. I think the Wealthsimple investment was good because you front run the retail investor, right? And here, again, they're doing green energy for a while, which has been doing good. And then you have China, which I think is the most important thing for upside. So a lot of people view Power and Power specifically as like not a big China player because Sun Life and Manulife have aggressively moved into China and the Asia region. They're both trying to grow there because Canada, there's kind of limited grove. In Asia, they kind of view it as unlimited growth or at least a much higher growth rate. Sun Life, I should mention, I checked them out as well before I invested in Power. And they, like I just said, they have a fairly aggressive lineup for Asia. And I want to say they hired 69% year over year increase in like sales reps, or maybe they call them investment advisors. But Power Sustainable China is another way to get into China. And they also have China AMC as well. So that's right here. And this company actually continues to grow and actually accelerated again another 10%. And this is quarterly numbers, right? But China AMC performed very well during 2020. And you saw that right here. When your assets under management go up 40% in a year, yeah, you're doing something right. And it's number one onshore EFT issuer, number two Chinese long-term mutual fund manager. I think this investment's underappreciated in Power's portfolio. And don't get me wrong, it's only, even if that was true, China AMC is only 2% of the NAV, so not a huge part of the whole company. It's not like you're owning Power for China AMC. I'm just saying it's there. And it helps get some exposure to China. And then, yeah, there's just another slide on China saying that they own it directly and then they own it through IGM Financial. Combined interest of 27.8%. And then the standalone business, I'm going kind of quick here. They have Peak and GP Strategies, Intramed. So standalone businesses, as the name would suggest, are just investments in businesses that stand alone. So they're operating units all on their own. And Line Electric is one we'll talk about in a little bit in a second. But again, that was another investment they made where they invested like 70 million and turned it into 800 million. And that's at the Holdco level, which is good, right? If one of the investment theses is the NAV gap to slowly close, not completely close, but decline a little, the investment decisions like Lion Electric would be indicative of that, right? Another way to do that would be to remove some of the costs in the Holdco itself, right? AKA get rid of middle management and stuff like that. So the financials themselves, I was going to start typing these out, but honestly, when I started going through the financials, I was like, Jesus, 500 pages in this thing. So, and that's like, I saw that when I did AIG a long time ago, like a lot of pages to read through. So anyway, this is just the one, I think this just helps highlight how important Lifeco is to the company. And then IGM and GBL as well, specifically this line. So this is the line for earnings, net earnings. And you can see Lifeco is the bulk. So if Lifeco does well, Power is going to do well. And if Lifeco does bad, Power is going to do bad. So it's Great West Life, Lifeco, Canada Life. They're all kind of the same thing. It's the insurance side of Power. And then you have IGM, the asset manager side, the next bigger runner-up, GBL at 27, and then all the rest combined, 46. And you can see how did it do during COVID. Earnings actually accelerated. And I think Q1 is going to be good as well. And then you can see the split out for earnings per share for each area. And again, you can see just how Lifeco, Great West Life carries it. And IGM as well, and GBL and China AMC starting to contribute more and more each year. But yeah, you can see earnings go from 250 to 308 during the COVID year. One of the reasons why it screens at a PE of 10, right? The discount to NAV is also pretty good here. This is another reason to look at it. So some people literally buy companies because they trade at a discount to some of their parts, but You got to remember that there's a reason they're trading at a discount, and usually it's because of management underperformance over the years, right? Or there's some higher costs in the Holdco. The discount, I don't view that this thing goes down like crazy, but I feel like a 15% discount is more realistic than a 26% discount, especially if they keep making good decisions. And that's another thing. So in 2020, they made some, in my view, made some good decisions. Because I looked at Power, I want to say 3 years ago, and I didn't buy it. And one of the reasons why is because I couldn't fully understand it. Like I tried, kind of like today when I'm trying to explain it, you can see that I'm struggling at some parts because there's a lot going on. There's a lot of pieces in this company. So what they did right before the crisis, they did a reorg. And so I think this is one of the reasons why it got as cheap as it did. And I was able to pick it up under $20. People kind of freaked out. They're like, oh my God, there's a reorg. And then you have this crisis and financials got smoked again. People were panicking, kind of like the financials are the epicenter of the 2008. So they kind of extrapolate that for this one, even though this one's a pandemic induced one. So anyway, you can see that they basically simplified the structure. So they used to have Parkiza, which I didn't mention yet, and they have GBL, and they kind of just put it under GBL. Empowers acquisition of personal capital. It's another smart move. Personal capital is like a direct to consumer. So again, you kind of cut out the sales rep that has to sell you stuff. You kind of let them go on the platform, and if they want to talk to somebody, they can, kind of thing. And I think that model is going to do well, especially for people my age that are interested in investment, right? So basically, I'm looking, did they take advantage during COVID, right? So Wealthsimple isn't public yet, but put their investment in early, and they can see right here that they put 114 million in, and now the pre-valuation dropped is at 934 million with an IRR of 44%, which is pretty nice, right? Well, that's already right. This isn't like an IPO price. It's like Robinhood's going. It'll be like a crazy amount. Similar thing could happen with Wealthsimple, though at a lower scale because Robinhood is American and Wealthsimple's Canadian. But similar idea. And again, you can see how they owned it. They have 61.7% fully diluted, but they own this through, like, let's say they own it through Great West Life, they own it through IGM, and then Lion Electric was the best example of a good decision. They basically put like, I want to say 80 million in to Lion Electric. Now it's worth 812 million to them, so NAV increases 737 million, which is a nice return, right? 10 bagger. And I think if the company can do decisions like that, that NAV is going to close over time, or at least that's what I'm thinking. So Wealthsimple, I kind of talked about it. It's like not a huge part of the company, but you can see this hockey stick growth, right? It's starting. And I think that trend is just going to continue with the do-it-yourself attitude that we're seeing in the markets. And then personal capital, I kind of talked about. It's basically you can use it to track your expenses, your bank accounts, and link everything together, link your investments together. And really, it's just a way to get direct-to-consumer online. And I think those type of like fintechs are going to be more important, as I think the traditional bank, as you go into the branch, is just going to decrease over time. And then we look at the share performance, and you can see during COVID panic, this thing just got destroyed, right? $34 at 10 or 20, sorry, 10 to 20. I believe I saw it trend to 19 something, and I didn't buy it. And then I was like, I'm going to buy it if it hits under 20 again. And then I did. May last year, that's when I bought it. So relatively lucky in timing. I was kind of slow on the draw, but I saw it here, and I was like, I looked at Q1, and I'm like, okay, I got hit a bit, but not losing 33% of your value or something. So I was like, all right. And then sure enough, 2020 was actually better than 2019, but the market still freaked out. And it's materially better still, right? And you're at the same price point. And that's why the PEs looks cheap, right? I mean, for all we know, we're going to go into a recession tomorrow, but that's not my call. And then we see how it performed in the last recession as well. If I go back farther, you can see great financial crisis again, hit even cheaper and got back into this range. And it's been kind of stuck in that range. And we're there again at the high end. So it's kind of like, oh, should I buy it now or not? It's a tough call to make. I'm going to hold it because that's what I do. As interest rates slowly increase, I want some type of assets that increase in value with it. And that will be banks. I mean, for all I know, the next back half of 2021, they're going to decline again. But I think over time, this thing's going to slowly trend up, especially if they keep making good decisions. But yeah, this investment's a little bit, I want to say, less risk than the other ones I've been doing lately. Mainly because it's a bigger established Canadian financial institution or conglomerate of financial institutions. Still like Power, it's trading right now, trading at 10, 11 times earnings. I think earnings are going to accelerate Q1 again, but we'll see. We'll see what the numbers say. I mean, relative to Manulife's also trading very cheap. Sun Life's trading a little bit more expensive, but they actually grew better than the other two did. We'll have to see that. But Power, you also have the NAV discount over 27. Say it goes to 20 instead of 27, you're up another 7%, right? And then fintech, like many banks and financial institutions, a lot of them are kind of limited in fintech investment. And I think Power is kind of taking it up a level. I think Wealthsimple is smart. Personal Capital is smart. Simplifying the Holdco structure also makes sense to me because it is still rather confusing. Like, this video is still going to be longer than I want it to be, and I didn't really dig into any numbers specifically, right? It's just they own so much things, it's just hard to go through it all. And another point that's good for Power is that they've made good decisions of capital lately, like the Align Electric example. And then the final one is just like portfolio diversification. It has quite a bit of its operations in Europe. It's in Ireland and UK and Germany. And GBL, which is like 9% of the NAV. And that's also dominated by France. And then they also have AMC in Asia. But again, that's only 2.5% of the NAV. I'd kind of view this as a way to get investment exposure to a more global reach than just say Great West Life alone or Sun Life alone. And you get a good valuation, a higher dividend yield than the others, right? And you get a discount at NAV. So that's kind of why I like Power more than the big three, the traditional big three. Anyway, I'd like to know your thoughts on Power. It's a little bit different than what we've talked about in the past. But yeah, have a great Easter break.